As you can see here, the Australian stock market index, big economy, so very similar to the other big indexes when these big events happen. The heading there, I like Australian shares have climbed a wall of worry. As you can see, 1900 it was about 8, and recently up to about 8,200. So just incredible. Very important quotes here next. Yeah, as you can see at the top there, Warren Buffett says a market downturn doesn't bother us. It is an opportunity to increase our ownership of great companies with great management at good prices. Very important, seeing downturns, opportunity to buy more shares in great companies. Benjamin Graham, who wrote The Intelligent Investor. The Intelligent Investor is a realist who sells to optimists and buys from pessimists. Yeah, last quote at the bottom. You make most of your money in the bear market. You don't realize it at the time. Very important to see bear markets as great opportunities. So here's an interesting case study of a European bank, and this falls into a subclass of investing called dividend investing. As you can see there at the top, near the top, on the graph, not on the graph, on the table, the yield, that is the dividend yield. You can see, obviously, COVID hit it, but then here in 2022, we got a dividend yield of 13%, projected 23, 15, projected 24, 17.4%. That is just dividends you receive on your stock, the percentage of your value in the share, excluding stock price growth. The shares actually increasing in value. So the S&P 500 has increased approximately 13 point something yearly over 10 years compounded. So you can see here from 2023, they're expecting dividend yields of 15.8, and then 2024 17.4, with the current one of about 13.3. So this is astronomical returns, higher than what the S&P gave yearly just in dividends. As you can see, this company looks very solid, with the analyst recommendations 4 say buy, 3 outperform. Their recommendations are also increasing over time, more buys and outperforms compared to hold. Their target price is also increasing, so it seems like a really safe company. Something that's a bit of a trick, like a trick a person learns over time. Companies that are not like worth hundreds of billions, but maybe a smaller company worth $1 billion or $2 billion, which is still a big solid company. You can see there the payment date of the dividend. That was an interim dividend payment of 37 euros, you can see, paid there. And then the stock price drops, as you can see with the green dots. The last 1, 2, 3, I'd say. Yeah, it seems. When that big dividend's paid, the stock price drops. As you can see now, recently it dropped from, what does that say? The yellow little block says 708 euros. It's now 6.12, say. So that share price has dropped almost 20%, from 6.1 whatever to 708, almost 710. Is almost 20%. So a good strategy is, right after a dividend payment on a high yield stock, buy the stock in the drop. You got approximately a 20% upside in stock price appreciation, as well as the massive dividend it pays regularly. So that's something I've noticed with companies that are not that big, and really available to the smaller investor, because obviously these companies you can't put billions of billions in, so much larger investment companies just don't look at them. As you can see from this graph, over time there are flat areas as the share prices go up very well over time. You have flat areas, like at the top right there, it says the lost decade, where the market was basically just flat from 2000 to into 2000, maybe 12. So that's why it's such a great thing to buy dividend paying shares. If you buy a share like this last one that's paying 15% or more and growing each year, you can be getting huge returns in dividends while you're waiting for the market to rise.